Tax brackets confuse almost everyone. In the next 10 minutes, I'll explain exactly how they work, what changed for 2026, and how to legally pay less. Many Canadians feel overwhelmed by the complexity of our tax system, often leading to missed opportunities to save money. We're going to break down the federal and provincial tax brackets, explore how inflation impacts them, and highlight some key differences to current year figures. Our goal today is to equip you with clear, actionable knowledge so you can approach your 2026 taxes with confidence and a solid understanding of how to optimize your financial planning. Stay tuned to unlock the secrets of tax efficiency. At its heart, Canada operates on a progressive tax system. This means that as you earn more income, higher portions of your earnings are taxed at progressively higher rates. It's a common misconception that if you cross into a higher tax bracket, your entire income is suddenly taxed at that higher rate. This is absolutely not true. Only the portion of your income that falls within a specific bracket is subject to that bracket's particular tax rate. Think of it like a series of buckets. Your first dollars fill the lowest taxed bucket, then the next dollars fill the next bucket, and so on. Understanding this fundamental concept is crucial for grasping how your overall tax burden is calculated. In Canada, your total income tax liability is determined by a combination of two distinct levels of government, federal and provincial, or territorial. The federal government sets its own set of tax brackets and rates, which are applied uniformly to all Canadians, regardless of where they reside. However, each province and territory also has its own separate set of tax brackets and rates. This means your total tax bill will differ depending on which province you call home, even if you earn the exact same income as someone in another province. We'll be focusing primarily on the federal brackets, but always remember to factor in your specific provincial rates. Let's dispel a very common fear, the idea that earning even $1 more can push you into a higher tax bracket, causing your entire income to be taxed at a higher rate. This is simply a myth. You will never take home less money by earning more. What you need to understand is the difference between your marginal tax rate and your average tax rate. Your marginal rate is the rate applied to your next dollar earned, while your average rate is your total tax paid divided by your total income. Your average tax rate will always be lower than your highest marginal tax rate, meaning every dollar you earn still contributes positively to your overall take-home pay. Now, let's talk about the official federal tax brackets for 2026. These have been indexed by 2% to account for inflation. The lowest federal bracket, taxed at 14% for 2026, applies to every dollar you earn up to $58,523. The next bracket, at 20.5%, applies to income between that figure and $117,045. Higher brackets include 26% up to $181,440, 29% up to $258,482, and the top rate of 33% kicks in on every dollar over $258,482. These adjustments ensure that even as the cost of living rises, your tax system shifts with it to prevent bracket creep. Why do tax brackets change annually? The Canada Revenue Agency, or CRA, automatically adjusts the federal tax brackets and many tax credit amounts each year based on inflation. This process is called indexation. Its primary purpose is to prevent bracket creep, a situation where inflation pushes your income into higher tax brackets, even if your real purchasing power hasn't increased. Without indexation, you'd effectively be paying more tax without actually being wealthier. The adjustment is typically based on the Consumer Price Index, or CPI, which measures changes in the cost of living. This ensures our tax system remains fair and responsive to economic realities. Let's put this into practice with a concrete example. Imagine you earn $90,000 in taxable income in 2026. Based on the 2026 federal brackets, the first $58,523 is taxed at 14%, which equals $8,193.22. The remaining portion of your income, which is $31,477, $90,000 to $58,523, falls into the next bracket. This segment is taxed at the 20.5% federal rate, equaling $6,452.79. Adding these together, your total federal tax on $90,000 is exactly $14,646.01. This calculation clearly demonstrates how the progressive system ensures you only pay the higher rate on the dollars that actually land in that higher bucket. Beyond the federal layer, we have the provincial and territorial tax brackets, and this is where things get truly diverse across Canada. Each province and territory sets its own unique set of income thresholds and corresponding tax rates. This means that a resident of Alberta, for example, will have a different provincial tax liability than someone earning the exact same income in Quebec or British Columbia. These provincial rates can significantly alter your overall after-tax income. It's imperative to consult the official financial information for your specific province or territory when planning your finances for 2026 to get the most accurate picture of your tax obligations. To illustrate provincial differences, let's look at Ontario. For 2026, Ontario's brackets have been indexed by 1.9%. The lowest Ontario bracket, taxed at 5.05%, applies to income up to $53,891. The next bracket, at 9.15%, covers income between that threshold and $107,785. Brackets then go to 11.16%, 12.16%, and finally 13.16% for high earners. However, keep in mind that other provinces like British Columbia actually saw a rate hike this year, with their lowest bracket increasing to 5.6%. This highlights why your location is just as important as your income when calculating your final 2026 tax bill. When you talk about your tax rate, you're generally referring to your combined federal and provincial marginal rate. This is the true percentage of tax you'll pay on your next dollar of income. For example, if your income falls into the 20.5% federal bracket and the 9.15% Ontario provincial bracket, your combined marginal tax rate on that portion of income is 29.65%. It's important to be aware that for very high earners, especially in certain provinces, the combined marginal tax rate can exceed 50%. Understanding this combined rate is crucial for effective financial planning, as it directly impacts your take-home pay from any additional income you earn. Beyond tax brackets, non-refundable tax credits play a significant role in reducing your overall tax bill. Unlike deductions, which lower your taxable income, credits directly reduce the amount of tax you owe. The most significant and universal is the Basic Personal Amount, or BPA, which allows all Canadians to earn a certain amount of income tax-free at the federal level, and often provincially as well. For 2026, the federal BPA is also expected to be indexed, potentially reaching around $15,800. There are also credits for dependents, tuition, medical expenses, and many others. Maximizing these credits is a key strategy for legally paying less tax, so ensure you claim everything you're entitled to. While credits reduce your tax bill, deductions reduce your taxable income. This is incredibly powerful because it effectively lowers the amount of income that even enters the tax bracket calculation in the first place. The most prominent deduction for many Canadians is contributions to a registered retirement savings plan, or RRSP. Every dollar you contribute to an RRSP reduces your taxable income by that same dollar amount, potentially dropping you into a lower tax bracket. Other common deductions include eligible childcare expenses, union or professional dues, and certain moving expenses if you relocated for work. Leveraging these deductions is a cornerstone of intelligent tax planning. One of the most effective tax planning strategies for many Canadians is to maximize their registered retirement savings plan contributions. When you contribute to an RRSP, that amount is deducted directly from your taxable income, potentially moving you into a lower tax bracket and reducing your current year's tax bill. The beauty of an RRSP is that your investments grow tax-deferred within the plan until you withdraw them in retirement. The assumption is that you'll be in a lower income bracket during retirement, meaning you'll pay less tax on your withdrawals then. This strategy not only saves you tax now but also helps build substantial wealth for your future. For couples, income splitting can be a powerful strategy to reduce your household's overall tax burden. The basic idea is to shift income from a higher-earning spouse to a lower-earning one, thereby taking advantage of the lower marginal tax rates of the spouse with less income. A common method for this is contributing to a spousal RRSP. The higher income spouse contributes to an RRSP in their partner's name, receiving the deduction, but the withdrawals in retirement are taxed in the hands of the lower income spouse. This can result in significant tax savings over the long term, making it an essential consideration for couples planning their finances. Beyond employment income, how your investment income is taxed also provides significant planning opportunities. Not all income is taxed equally. For instance, only 50% of capital gains are taxable, meaning if you sell an investment for a profit, only half of that profit is added to your taxable income. Eligible Canadian dividends also receive preferential tax treatment through the dividend tax credit, which effectively reduces the tax you pay on them. Understanding these distinctions allows you to strategically structure your investments within different accounts, like TFSAs, RRSPs, or non-registered accounts, to minimize your overall tax liability. A diversified approach considering tax efficiency is key. Given that our 2026 figures are projections, it's absolutely critical to know where to find the official, confirmed information. The Canada Revenue Agency, or CRA, is your primary source for accurate tax bracket information and all related tax rules. The Department of Finance Canada also releases important budgetary and tax policy announcements. Always cross-reference any information you find with these authoritative government websites. Tax laws and regulations can change, and staying informed directly from the source ensures you're working with the most up-to-date and accurate data for your financial planning for the 2026 tax year and beyond. Now that you have a clearer understanding of how tax brackets work and what to expect for 2026, what can you do right now? First, take some time to review your current 2024 and 2025 tax situation. Understanding your current income, deductions, and credits will provide a solid baseline. Next, start projecting your income and major expenses for 2026. This forward-looking approach allows you to anticipate your tax position. Finally, and perhaps most importantly, consider consulting a qualified financial advisor or tax professional. They can provide personalized advice tailored to your unique situation, helping you optimize your tax planning strategies and ensure compliance. Let's recap the most important points for navigating 2026 Canadian tax brackets. Remember, our tax system is progressive, meaning you never lose money by earning more. Federal and provincial rates combine to determine your total tax, with provincial rates varying significantly. The projected 2026 brackets will be adjusted for inflation, so our estimates serve as a guide. Most importantly, proactively leverage strategies like RRSPs, TFSAs, and understanding various deductions and credits. These tools are designed to help you legally reduce your tax burden. Always prioritize staying updated with official CRA announcements as 2026 approaches. You've now got a solid foundation for understanding 2026 Canadian tax brackets and how to approach them strategically. Our goal is always to empower you with the knowledge to make informed financial decisions and optimize your hard-earned money. Don't let tax season catch you off guard. Instead, use this information to plan proactively. If you found this explanation helpful, please consider subscribing to our channel for more expert insights into Canadian finance and tax planning. We're committed to helping you navigate the complexities of personal finance with clarity and confidence. Thank you for watching. If you liked this video, please like and subscribe.